Thrasio at one point had a paper valuation of $10 billion. They were, at the time, the fastest startup to reach unicorn status, which is a valuation in excess of $1 billion. Look back 18 months, and over that period of time, there were signals that the 800-pound gorilla could be taken down. But then fast forward again, later in 2023, and there were murmurs of bankruptcy. It all happened very fast.
When I first heard about the bankruptcy, my first thought was like, wow, okay, what was going on that I couldn't see?
As you may or may not have heard, Thrasio has recently declared bankruptcy. And this episode explores the reasons behind that declaration of bankruptcy and the implications that that has for the entire industry, for Thrasio itself, and all of us as sellers. And as I explore this with John Durkitz, I honestly did not expect the implications and the impact to be as wide-reaching as they actually are. And this episode is really, really important, partly, of course, because this is just one of the bigger things I think that's happened in recent years in e-commerce, but it also kind of displays just how much this industry is changing, and it also kind of emphasizes the importance, I think, of keeping up to date with things like this. So we'll explore. John is well equipped to discuss this topic. He walks us through all the reasons for why Thrasio has declared bankruptcy and what we need to know about it that impacts us as ourselves and impacts the entire industry. So there's a lot to unpack here. This is one of my favorite recent episodes as of recent. I enjoy episodes that kind of dive into news like this. So let's dive into this Thrasio bankruptcy and what it means for us as sellers and the market as a whole.
Hello, everyone, and welcome to another episode of Human in the Loop. I'm Cameron. I'm joined by John today, and we're touching on something that some people in the industry know about, and some people don't. A lot of people don't know about it, and that is the bankruptcy of Thrasio. We're talking through what happens, first off, what Thrasio is, what they do, what happened, and why it's so significant. But John, before we get into the meat of the conversation, tell us a little bit about yourself. Can you just introduce yourself, tell us where you're from, and how long you've been in the industry?
Yeah, Cameron, first of all, excited to be here. This is a really cool topic. It's a nerdy topic, but that's kind of my specialty. And this news is literally a month old. Early March was when the bomb dropped and all these really interesting and meaty bankruptcy filings associated with Thrasio came out. And there are over 200 filings at this point. There's a lot to go through. But we're going to unpack it today. It'll be fun. But yeah, quick elevator pitch on me. My Amazon journey started in the most unusual and unexpected places, which was in the belly of the beast at Amazon. Back in 2016, I was hired to run the third-party marketplace for consumer electronics on Amazon Canada. So really saw how the sausage was made from the inside, but more importantly, had an opportunity to work with top brands on the outside and understand their pain points. Be an advocate for sellers within Amazon, because there are very few of those, as sad as it is, as odd as it is, considering sellers comprise 60% of marketplace GMV. There just are very few people within Amazon for which sellers are their customers. So I was in a role where sellers were my customers, and I was overseeing the marketplace. That gave me a taste of the marketplace, which led me to leave in 2019, and then do a number of other things, all entrepreneurial in nature. Start my own brand, start an Amazon consulting agency. I had a brief stint at an aggregator. These days, I run an Amazon agency along with a partner, a fellow ex-Amazonian called the Master Agency. That's probably about 80% of my time, with the remaining 20% focused on running my brands. Because I've after launching a brand, getting a look at Amazon aggregation from inside an aggregator, I then went on to acquire more brands, which, given the current climate, maybe is a decision I would challenge my past self on, but we'll save that conversation for
That's another podcast episode.
That's right. Hopefully not in the context of my own bankruptcy.
Yeah, of course. No, this is really good because honestly, you've obviously been in the mix in a lot of different ways in the industry. That's why your insight is so valuable here. That's why you're so knowledgeable. John, let's start at kind of a very basic level, because I'm guessing some people have heard of Thrasio, some haven't. So can you just tell us, like you mentioned the word aggregator, can you tell us, which I've learned that aggregators are not very fond of, but can you tell us an overview, give us an overview of Thrasio? What does, or I guess does Thrasio do?
Yeah, that I'll give kind of the 101 overview here. And just to contextualize how significant this is, Thrasio at one point had a paper valuation of $10 billion. They were, at the time, the fastest startup to reach unicorn status, which is a valuation in excess of $1 billion. They raised billions of dollars of venture capital, or just capital in general, which was a mix of venture debt and equity. They were a behemoth in a nascent and growing industry that for a lot of people was very exciting, given some of the secular tailwinds that existed at the time. But let me back up.
What year is this, like, reaching unicorn status? Like, what period of time?
Yeah, I think so. If you look at the paperwork, I think Thrasio was formally incorporated in maybe late 2018. They started to acquire in mid 2019. And then kind of the unicorn valuation happened maybe a year later in mid 2020. And again, these are paper valuations. Nothing, the market ultimately determines the valuation of a company based on what people are willing to pay for it in terms of shares or in terms of, all out acquisitions. But it all happened very fast. And it coincided with an event that shocked all of us, which was COVID, right? In Q1 2020. But let me back up. Thrasio was sort of the OG Amazon aggregator. Amazon aggregator is a term that kind of emerged to describe a business model and strategy that involved going out and buying Amazon native businesses, Amazon FBA businesses. The strategy was really a 21st century version of a strategy that had been around since the late 80s and was rooted in the private equity world. Private equity firms have been doing roll-ups since the late 80s. This was just a 21st century version. And I often like to tell people, that Nietzsche quote, "Time is a flat circle." That there's that great scene in True Detective about that. But that's really the case here. This was just some people with a digital background looking at an asset class in Amazon FBA businesses and saying, hey, we can combine these. We can streamline operations. We can generate economies of scale. We can acquire market share. And through all of that, we can expand the valuation. It's an idea whereby the whole is greater than the sum of the parts.
And it was happening at a time where a lot of these FBA businesses were becoming really legitimized too, right? Like in the maturation of FBA, where it used to be back in the day pretty scrappy, like a little illegitimate from some people's perspective. And around the time that aggregators started becoming a thing, at least from my perspective, was when FBA businesses were really maturing, becoming legitimate. I think that influenced a lot of the perspective to draw and aggregate and streamline processes as well.
That's exactly right. And, among the things that I do, I serve as kind of an Amazon expert for institutional investors, and I take a lot of expert calls with them. And in 2020 and 2021, I had a lot of conversations with institutional investors who were trying to accelerate their understanding of Amazon FBA businesses from a cost perspective, from a demand perspective. And I think the undertone of those conversations was they realized that Amazon FBA businesses were legitimate businesses with great margin profiles at the time and great growth prospects. And so there was this recognition that there was this whole class of businesses out there that hadn't yet been rolled up. And PE's been rolling up businesses in different industries for decades. It worked in those industries. Let's just copy paste over here. So that was the thesis behind Thrasio. I said that Thrasio was sort of the OG, but truth be told, they weren't the first aggregator. So a couple little bits of trivia. I don't know who was the first, but before Thrasio, there was a little company that I knew at the time called Mohawk, who rebranded as Ethereum, which is now a publicly traded company. They rebranded, I think, in 2021, and also started calling themselves an aggregator because, that was a term that attracted venture money at the time. But Mohawk was a mix of, homegrown brands, but also an acquisition engine. They did go out and acquire businesses. One of my favorite acquisitions of theirs was Squatty Potty, so they used to, I don't know if they've maybe divested it, but they acquired Squatty Potty. So Mohawk / Ethereum was an early one. And then there were a number of smaller ones that started out in 2017, 2018, principally focused on distressed Amazon businesses. Alpha Rock Capital was a small one they were operating. But the point is, Thrasio was not technically the first, but they were and are the OG in many people's minds. And I think rightfully so.
Well, this is interesting. It's interesting then that Thrasio garnered a lot of attention, like you said, the $1 billion unicorn status, right? And we're walking through the timelines here, and we're at kind of this inflection point where Thrasio starts becoming recognizable. They start doing really, really well. And I'm curious to hear your perspective on why they were able to, how they were able to reach that unicorn status so quick. So from your perspective, like moving into the second string conversation, how is Thrasio able to do it? Like what about them?
Yeah, I think that there were a couple things that led to their meteoric rise. Thing number one was just the macro environment. Rewind the clock 5 years, and it's crazy to say 2019 is 5 years ago, but it is, right? 5 years ago, we're in a low interest rate environment, zero interest rate environment, and investors are sitting on piles of cash looking and chasing yield in different places. So investors looking to deploy funds, a new business model emerging with, on paper, attractive returns, is going to attract funds. So you had an investment community that was very bullish on this model. And with Thrasio being the only game in town, initially, they attracted a lot of funding. There were lines out the door to write them checks. So their rise, in part, was a function of the fact that they were first and that they were the only game in town for a while at a time when investors were looking to deploy capital. I think another thing that led to their rise was, and this is, we're fast forwarding now to early 2020, COVID, right? It unprecedented, but the first half of 2020 and 2020 overall, we had 2 years of e-commerce growth in 1 year, right? E-commerce share as a percent of retail just spiked, and it's since normalized. That's part of the story here that we'll get into. But I'm looking at the data that I pulled here. In Q1 2020, e-commerce as a percent of total retail was 11.7%. 1 quarter later, it was 15.6%. So a massive uptick. And that, incidentally, is also a time when a lot of other aggregators emerged and said, hey, we can do this too, give us some money. But because Thrasio was there during that time, they benefited from, being more established in the eyes of investors. So, there's kind of the macro things, low interest rate environment, timing, and then maybe on the micro or on the Thrasio business side, they built a team that investors could believe in, right? The co-founders, Carlos Cashman, Josh Silberstein, kind of came from the digital marketing community. There was belief and conviction around what they could do. They hired an all-star team, including, your old friend and boss, Casey Goss from Viral Launch, right? There are a lot of big names in the Thrasio tent, and that gave investors conviction. So I think it's that combination of macro and then on the micro or business model side, putting together a team that could reasonably deliver on the model.
Thrasio seemed, here's my perspective, and I like to gather sentiment from people in the industry too, right? Like Thrasio they had unlimited cash, quote unquote, unlimited cash. from investors. And I think that's part of why this whole thing is so shocking. And it's great to see the sense that I get when I first heard about the bankruptcy. My first thought was like, wow, okay, what was going on that I couldn't see? And I feel like a lot of people shared that as well. Like, okay, was it just a facade? Was there just, I'm just saying all this to say, like, okay, we're at this point in time where obviously like things are going really well. And due to those factors that you mentioned, external and internal, they didn't have a rock star team. I mean, Casey was a part of that team. Like I was connected somewhat to I knew a couple other people on the team as well. I was connected to the conversations internally. They're aggregating, buying up brands, like a lot of brands. Where do things, I want to leave the door open if you want to touch on anything else there, but I see a transition here of like, where did things start to unravel then? Where did things start to go wrong?
No, let's move to the second half of the story. So, we touched on the history, what Thrasio was, how they kind of rose. Now, where does the story crest and start to come down? I think, like you said, outwardly, there was this kind of perception of 800-pound gorilla. And you said it yourself, a lot of people saw them as invincible. I think if you were in the industry, kind of like myself, you started to see cracks in the armor emerge in mid-2022, if I remember correctly. One of those early cracks that I perceived was there were rumors of Thrasio going public. And this, of course, got everyone excited. Candidly, got me excited too, because I was in the industry at the time. And, I wanted to see every aggregator go public, every early employee get rewarded, right?
Of course.
And so again, you'll have to check my timeline here, but I believe it was kind of mid-2022. There were rumors of them going public, maybe first reported in like TechCrunch or one of those other publications. But fast forward 3-6 months, and by the end of the year, they hadn't gone public. And then there were subsequent murmurs about just accounting madness within the company. Messy books, they were in no way ready to go public. And that coincided with their CFO at the time, either resigning or being fired, doesn't matter, but bringing in a new CFO. That new CFO, who was a reputable person, I think from either JCPenney or Nordstrom, one of the, someone with a strong pedigree, that person was there for 3 months and walked away. And so you see these little movements in the leadership team and you're like, that's odd. But fast forward.
If you're paying attention to the story, like if you're looking for details, you're starting to see some of these things unravel. Like, okay, hang on, what?
Yeah.
Even though it's like there's still excitement wrapped up in all this too, probably.
Yeah, there's still excitement, but if you're paying attention to the minutia, there are aspects of the story that don't make sense, the outward story that don't make sense. So, that kind of accounting and finance disarray, and some movement in leadership there was a signal to me that, okay, maybe there's something amiss. But still, bullish. I wasn't out there predicting that they were going to fall by any means, but it raised alarm bells. Fast forward to 2023, I do M&A advisory work too, so I'm plugged into a lot of different places. But early 2023, Thrasio stopped acquiring businesses. So it's not a risk signal or a red flag by any means, because at the time they had like 200 brands. So, you have to pause at some point. But, it's just another data point. And then there was the big shakeup in, I want to say, April of 2023. I might be getting my years wrong at this point. They stopped. There was a big layoff, right? And I think that was when they had the CEO shakeup too, when the original founders, the co-CEOs, Josh and Carlos, both went away. I think Josh maybe had left 3 or 4 months prior at the end of 2022, but then Carlos was gone. They brought in Greg Greeley, who was a big name from Amazon. He was also at Airbnb. So they kind of shifted the leadership team around that time. So all this was happening, and I'm like, that's interesting. But at the same time, it is very accordant with a story, a plausible story around, we're just growing up as a company. We're maturing. the people that got us from 0 to 1 are not the people to take us from 1 to 100. So there's a plausible story there, and I think that was a narrative that existed. But then fast forward again into kind of later in 2023, and there were murmurs of bankruptcy, right? So the filings didn't happen until the first part of March, but late 2023, there was some reporting that it might happen.
Where were these? I'm guessing that wasn't necessarily public. Like, of course, Thrasio probably doesn't want to talk publicly about, like, who would want to talk, like, you're going to try to make everything as good as possible, right? Make it seem as good as possible too, probably. Where were those? Was that an internal thing? Like, people who were really just plugged in, like you were obviously plugged into a lot of these conversations. Is that where that was happening?
In the beginning, yes. But I think, again, I don't know if it was TechCrunch, Modern Retail Dive. There's a lot of good outlets that cover e-commerce and would have covered Thrasio. But I sort of remember around December of last year, there were murmurs. In fact, I probably tweeted about it at the time. There were murmurs that Thrasio would be declaring bankruptcy. So for me, as someone who geeks out about that stuff and was ready to dive into the bankruptcy filings, because, to put this into context, another aggregator, Benetago, they declared bankruptcy around Labor Day 2023. And I did a deep dive on that for my newsletter. So I'm just waiting for the next domino to fall. I'm ready to go deep on whichever aggregator declares. So I'm looking at my different sources for bankruptcy filings when that news on Thrasio came out, and nothing was there. And it wasn't until end of February, beginning of March that they formally filed. But yeah, just to put a bow on this, I think look back 18 months, and over that period of time, there were signals that the 800-pound gorilla could be taken down. And there were vulnerabilities that were not being talked about publicly, but were below the surface, and putting this future with a real possibility assigned to it.
If we were to, because you talked through the reasons behind, like, this unraveling. If you were to kind of summarize what you think the primary reasons for this unraveling are, what would you say?
Yeah. Great question. And the beautiful part of this question is there's no need for conjecture here. There's no need for conjecture here because as part of the day one motions in the bankruptcy filing, Thrasio's now CFO, a guy by the name of Josh Burke, had to prepare it ended up being like a 180-page filing. And this was really, for me, the best filing out of the 200 some that were part of the overall filing, the best document, because in this, he gives Thrasio's point of view on what went wrong. And there were kind of three factors that he talked about. Number one, and we hit on this already, the COVID pandemic impact. It led to a lot of things for Thrasio. Number one, they took on more debt to be more acquisitive. Number two, they hired a ton. And then number three, they bought a lot of inventory to feed demand that I think everyone thought would persist. Like we talked about in the data points that I gave, e-commerce as a percent of retail made a step change in its growth trajectory. And I think there was a view that it would step and then continue on the previous trajectory at that heightened rate. That's not what happened. If you go to Marketplace Pulse, which is a great source for industry data, you can see the chart quarter by quarter. It steps up and then it stays up, but then it comes back down. And we're now at a point where we're just on the trajectory that it was at before. Thrasio was a victim of that. And Josh Burke talks about it in the filing. I think the second thing he talks about was operational missteps and strategic missteps. One of those was inventory. And I'm going to pull the stat here because I talked about it in my newsletter. Thrasio vastly overbought.
Which correlates to your first point, right? Like that's connected obviously to that suspected rise and suspected continuous rise from COVID time.
Right. It's, we can sit here and Monday morning quarterback the crap out of this and question every decision. But the reality is, I was in the this world at the time, making strategic decisions, I would be hard pressed to say, let's adjust down our buys by 30% or 50% in the face of demand that was just exploding. The biggest problem for aggregators at this time was staying in stock. So to cut all these POs makes a ton of sense. And let's see, where did I have it here? They had something like 425 million of excess inventory at the end of 2022, which is just a staggering amount. But Josh Burke points to that. And then kind of related things in terms of operational and strategic missteps, overhiring, over-reliance on Amazon. They didn't do as much to grow these brands off Amazon as they might have could have. And then they made a lot of attempts to grow Thrasio bigger, faster, through kind of acquisition and expansion, non-brand acquisition and expansion. So what I mean by that is, you probably remember, they made big waves, or certainly put out a lot of headlines about their expansion into India. They were one of the first aggregators to push into Europe. A lot of these things just stretched them too thin. And that's what Josh talks about as kind of the third category, or the third driver of where they're at today. The need for restructuring is just the financial strain that they're under. They're over leveraged. Their debt is too expensive, which is common for a lot of aggregators right now. And they just don't have the liquidity to fully move forward the business. And that's what the bankruptcy process, the Chapter 11 bankruptcy process, will afford them: ability to restructure this debt and get on solid footing to grow the business going forward.
See, and part of what I want to touch on next is like, okay, where does Thrasio go from here? Bankruptcy, and I'm putting myself in this bucket. That's a scary word for a lot of people. I think the assumption is that an automatic assumption for a lot of people is bankruptcy means done for, no more. But I don't know if that's the case or not. So I want to talk about that. But I think just touching on like the analogy of like football commentary, I think is a good one. I think it's easy, and it's a funny way to picture this too. I think it's going to be easy for a lot of people as they talk about the Thrasio story to just kind of like point out everything that went wrong and just say like, oh, that's, I would have done it so differently, which is definitely not what we're saying. But I think in just the industry in general, it's easy to approach this conversation like that. In reality, like part of this, outside of maybe some internal infrastructure like overhiring and whatnot, the signals that Thrasio and everyone was getting at COVID time was like, this is skyrocketing. The response, so at least somewhat, I'm pitting it as like an appropriate response to like an unprecedented time, in the sense of like buying up inventory, of spending in a lot of ways that they were supposed to. And I think that certainly plays into this, combined with perhaps some missteps along the way. But going into this now, like bankruptcy and what it actually means for Thrasio, you talked about restructuring. What will actually happen to Thrasio next?
Yeah, I'm glad you brought up this concept I'm glad you brought up bankruptcy and what I think is a common misconception of what it is and isn't. And I'm by no means a bankruptcy expert, but I've been kind of around enough to be dangerous in terms of what I do and don't know. But I think it's important to clarify here. This was a Chapter 11 pre-packaged bankruptcy. And let me hit on the first thing that I said, Chapter 11. The bankruptcy code in the United States has a long list of chapters that dictate how bankruptcy proceedings go. The two most common forms of bankruptcy are Chapter 7, which is a liquidation. That's the business going away for good. And then Chapter 11, which is a reorganization and restructuring. The directional arrow for most businesses goes Chapter 11, let's see if we can restructure in an orderly fashion and make creditors or equity holders mostly whole. And then from there, if we can't, then it's Chapter 7 liquidation. The important detail here is, again, Thrasio's bankruptcy was Chapter 11. It's a restructuring, and it's done under the supervision of a court, of a trustee. So all these filings that Thrasio made at the beginning of March, And I think the reason that there were rumors of bankruptcy 6 months prior was because this was happening. And all these filings were done in coordination and consultation with various creditors and with courts. So that's the important detail here. Thrasio will live on. They will, I say will, with a 98% level of confidence, because they will live on in a way that is more financially sustainable with them. Equity holders will either get wiped out entirely or substantial haircut. Debt holders will have to adjust their terms with Thrasio, but Thrasio will survive to fight another day. And that's the important detail here with Chapter 11. Although I can appreciate that, Thrasio declares bankruptcy, or, Unicorn Thrasio declares bankruptcy is a much sexier headline than Thrasio is going to restructure.
Of course. And that's why it's gained so much attention, I think, is because, well, I'm putting myself in this bucket again too, is because that is the thought that, Thrasio's done for work, like, they're not going to continue on. But that makes sense. So there's a whole lot of restructuring here. Perhaps, is downsizing the right way to think about this? Is that an appropriate term?
Yeah. I think there are different ways that they will try to right-size their business. There's OpEx, which people costs. Let's right-size the team relative to our portfolio. There's CapEx, which is, all right, we own these assets, these capital investments. Some of them might not be right for us. And then there's working capital, which is, like I said, they had $425 million in excess inventory at the end of 2022. The reality of owning Amazon brands or retail brands in general is they are cash intensive. You need to invest in inventory. So the question around these 200 brands that they still own is, are we going to continue to invest in inventory for all of them? So I think there's going to be some level of catalog downsizing, to use your word, catalog rationalization. There's always the Pareto rule in Amazon: 20% of your catalog accounts for 80% of your sales. Maybe Thrasio very aggressively looks at that 80% tail and says, we're not going to buy into these anymore. We're just going to end of life these SKUs. I think all that's on the table for Thrasio, but what gives me confidence is I think they have a leadership team that's capable of that. Again, the team that took them from 0 to 1 is not the team to take them from 1 to 100.
Sure. It sounds like, I can't even imagine putting myself in Thrasio's shoes, like imagining deciding to declare Chapter 11 bankruptcy for the long-term hopeful success of, like, okay, we're going to have to take a step back in order to take a step forward. It sounded like a necessary decision. And if they would have kept on going on, they would have had to just declare Chapter 7 bankruptcy and do a complete liquidation. So it sounds like things happened the way that they did. The decision was made. It sounds like they did this for the long-term success, hopeful success. So, John, kind of landed the plane conversation-wise here. I think an important aspect of this could be considered a symptom for the industry as a whole, right? Like, perhaps this is not just, a thought I have is perhaps this is not just Thrasio that's experiencing some of these things. I imagine it's not. So a big aspect of this conversation is what should people take away for what's happening in the industry as a whole? What does this signify for the e-commerce industry right now?
Yeah. Let me take that question in two parts. I'll speak to maybe the broader e-commerce industry first, and then the aggregator industry more specifically. I think on the e-commerce side, the signal is that 2024 is very different than 2019, 2020. Demand is softer. Margin compression is everywhere. On Amazon, it's your fee stack, but if you're broader in e-commerce, it's your input costs across kind of every cost in your business. And so, The waters are choppy, headwinds everywhere on the demand side, on the cost side. My personal belief is that e-commerce success in 2024 and beyond, and maybe just the short term, is going to be critically based on operational acumen and financial acumen. Because it's interesting. It's easier than ever to start a business, especially an Amazon business, with AI becoming more prominent and more useful in terms of product development, in terms of marketing, in terms of content. All those things have become super easy, but those things are not what drive value in the business right now, or at least enable a business to survive. The businesses that survive are going to be the ones that can manage their costs well, manage their cash flow well, and realize that there's an ideal rate of growth or an aspirational rate of growth and the right rate of growth for your business. And not getting out over your skis, especially now, is going to be critical for e-commerce brands more generally. To maybe simplify everything I just said, we're shifting now from growth at all costs to profitable growth. And that's the trend beyond just Amazon businesses. Venture funded D2C brands, same thing. They operated with negative margins, supported by venture money for a long time. In the 20 teens and early 2020s, that's shifted. There's no patience for that anymore in this kind of macro environment. So I think that's the trend in the e-commerce market, or at least the learnings in the e-commerce market more broadly. On the aggregator side, I think what we're seeing and what we will see in version 2.0 of the Amazon aggregator is just natural selection leading to variance of the aggregator model be the winning variance in this ecosystem. The version 1.0 of the Amazon aggregator was buy everything as quickly as possible, agnostic of category. Thrasio is the textbook case that we're talking about today as that why that is dangerous. But Perch, another big aggregator, recently had their own kind of forced marriage. And I'm going to call it a forced marriage because that's what it is. Outside of Thrasio, there's been a lot of consolidation in the aggregator space. And that's been the alternative to date to Chapter 11 bankruptcy, find a buyer. But I think for version 2.0 of the aggregator model, I see three models sort of winning. Model number one is an aggregator with very strong product development muscles. And my belief in this is rooted in the reality that the best Amazon businesses are the ones that develop products at a high rate. And, they maybe put out 100 products a year, knowing that only 20 are going to win, but they add to their revenue with those 20 and then scrap the 80 and they repeat next year. The best Amazon brands that I've worked for, both in Amazon and outside Amazon, product development engines. And, if we look at aggregators that are doing that very well, there's an aggregator called Goja, based out of Miami, based out of Florida. And they've been around for a long time. They were a seller before they were an aggregator. But that's where that product development muscle comes from. But then another one is an aggregator called Infinite Commerce, which was the marriage of a top Amazon seller, Juvo, which was really more of a seller product development engine first. It was a marriage between them and Cap Hill Brands, which was an aggregator out of Washington. So I think product development engines, product development platforms are one version of the aggregator model that will win going forward. Another version that I think is going to win are more traditional PE-like aggregators, meaning they keep founders involved for a long time, and they make fewer but larger acquisitions. And those two details are important here because part of the thesis of the aggregator model was we're going to replace the founders with people that are more competent and more capable.
Right.
And that was often
From
not
a business,
true.
like a business development perspective. Yeah.
Right.
Yes.
Another part of the aggregator thesis was we're going to make a lot of these acquisitions and benefit from economies of scale. and we're not going to have more operational complexity, or operational complexity will grow linearly. That's not the case. Operational complexity grew non-linearly, it grew exponentially. And so I think the playbook for Aggregator 2.0 is fewer larger acquisitions, much like a traditional PE firm would do. And then I think the third variant in Aggregator 2.0 that will win are what I'll call hedgehogs. That's a Jim Collins good to great phrase, but it's what I'm referring to here are aggregators that are deeply and intensely focused on a specific category or even subcategory, and all of their acquisitions happen in that space. So rather than going wide, they're going very deep. I'm talking like Marianas Trench deep. There aren't many aggregators that do that well yet, although some started that way. Intrinsic Brands is one that comes to mind, focused very deeply on women's health. But I think that's what it's going to take to win in this new aggregator environment. It's product development engines, traditional PE, and hedgehogs. Those are going to be the winners.
That's a really good insight. And what I find interesting is, the people that are listening here, there are people that are selling individual brands or bigger brands. There's a good mixture. But what I find interesting is that I think that there's a lot that you just said that applies to the modern day seller as well, the modern day brand. It's not just aggregators. In Aggregator, this definitely simplifies it, but aggregators are like brands and sellers at scale, at a very large scale. And there's a lot, I think, that sellers can gain from that. Like if the seller's listening, this conversation it is about, okay, bankruptcy, Thrasio, what does it mean? But it's also about what can I do? And I think this is a good point to end the conversation. And I just want to say, John, thank you for breaking everything down. There's a ton to learn from this whole process. You broke it down in a way that's very easy to understand. I really appreciate you coming on the show, talking through everything. My last question is, for people that are listening, where can they find you? How can they interact with you, engage with you, follow you?
Yeah, I'm active on social media, LinkedIn, John Durkitz. That is my more thoughtful, professional content. I'm also active on Twitter. My handle is Bearded Egg FBA. There's a long story behind that, but Twitter's a fun place to engage with Amazon people. And I guess the last place is I author a newsletter called Best at Amazon. And we could probably throw the link in the show notes. That's where I do real deep dives into a lot of different areas in the Amazon space, and deep dives into the strategies and tactics that I use for my brands. That's where I first wrote about Thrasio and their bankruptcy, and I think that's probably what led you to reach out initially.
Yeah, no, it is. I mean, John, I saw we're connected on LinkedIn. I don't actually even know if we were connected at the time. I saw your breakdown of Thrasio on LinkedIn, and I read your blog post. I'm like, oh, I got to have this guy on the show. So I will put I'll put your info, your connections in the show notes. People will find you. But John, really, thank you again.
Yeah, Cameron, thanks for inviting me. This has been fun.
Hey, everyone. Thank you so much for joining me on today's episode of Human in the Loop. I hope you learned a lot from this episode about Thrasio. It's really interesting to dive into the differences between bankruptcy itself and also bankruptcy in our industry. It felt like it is a really big shakeup, maybe one of the bigger shakeups over the last couple of years. And we'll keep an eye on what happens from this. I expect certain things to change and some things to not change at all, but the story is not over yet, and we'll be keeping a close eye on Thrasio to see what happens as time goes on. So thank you so much for joining me on today's episode of Human in the Loop, and I'll see you next time.